Assalamu alaikum. Welcome to the second part of depreciation. Now we are talking about recording depreciation. We have annual expense that will be charged to the income statement, and we have annual expense to date, that's accumulated depreciation, and this will be recorded in the provision for depreciation account. And the net book value is the asset cost minus the total or the balance of the provision for depreciation account. This is the theory. Now let's look to the example. We are using the same example we had in part 1. In part 1, if you remember, we used two methods to calculate depreciation: diminishing and straight line. Straight line have equal amount every year, while the diminishing is having different values starting from greater value to lower value. So our journal entries, we have the entries using the diminishing depreciation calculation, and in December 31st in year 1 we have income statement debit with 4,400, that's 20% of the 22,000 value of the asset, and the credit is provision for depreciation account, 4,400. In year 2 we'll do December 31st, income statement will be debit with the 20% of the remaining or the net book value at the end of year 1. That's 3,520, and the credit is provision for depreciation account. And the description for both entries is the same: to charge annual depreciation to profit. So in every year at December 31st we do the same thing. Very simple. The calculation that we did earlier in part 1, we just translated using entries here, because this is how we record the thing. If you remember the 4 steps of the process of accounting: recording, then classifying. Second step is classifying. So this is what we call posting to the ledger. Let's look at the general ledger. In the general ledger we have the asset account. It's not touchable. It's as it is. We started in year 1 on January 2nd. We bought 22,000 asset of $22,000, and the credit one was the bank. And at the end of the year, December 31st, we have the balance. It's 22,000. This is the balance carried forward. And in year 2, in January 1st, you have the balance brought forward, 22,000 as it is. End of year 2, December 31st, balance 22,000 as it is. Continues, no change. The only change that will happen, as you will see in part 3, when we do this disposal of the asset. But for this, stay as it is, no change. Now we go to the ledger account for provision for depreciation. First year, we have the first entry, December 31st, it's a credit coming from income statement. Income statement was the debit, it's 4,400. And the same thing, we do the balance carried forward on December 31st, 4,400. Year 2, we start in January 1st with the balance coming from year 1, 4,400. Then in December 31st, we recorded another entry, 3,520 coming from income statement. The total is 7,920. So our balance carried forward is 7,920. This is how we accumulate depreciation. So in year 1, we have accumulated depreciation of 4,400. That's the only entry in this year. Second year, we have accumulated depreciation of 7,920. That's the accumulated depreciation for year 1 and 2. And so on. Year 3 and year 4 will be the same thing. Now we want to see the presentation of the net book value in the statement of the financial position. We have year 1 and year 2. We have the cost, the accumulated depreciation, net book value. As we said before, we have the original cost, stay as it is, no change. This was the first thing, the general ledger for the asset. This is the accumulated depreciation, provision for depreciation account. These are the balances. And this is the net value. So 22,000 minus 4,400, 17,600. Again, 22,000, because 22,000 is not changing. 22,000 minus 7,920 is 40,080. That's the depreciation. This is how we record depreciation. Same thing is done with the straight line method. The only thing will change is the values. Now Remember we said there was a third method to calculate depreciation, that's revaluation. Revaluation method is re-estimating fair value of the combined non-current asset at the end of each accounting year. So at the end of each accounting year, we do estimation of the fair value of the non-current assets, and accordingly we adjust the cost of the asset. So the transaction is not touching the provision for depreciation account, but rather it is touching the asset account itself. Let's see the example. In January 5, we bought hand tools at $500. Then in January 10, we added hand tools for $80. Total is $580. So our assets original cost is $580. At the end of the year, we said the revaluation of at year end, saying that the fair value is $480, which means that we have lost $100. This $100 is our depreciation expense. It will be charged to the income statement as usual, but the credit part would be the asset account itself, not the provision for depreciation. Let's see the entry. General Journal, December 31st, we have income statement, debit with 100, and hand tools, this is asset account with 100, and charge provision of depreciation, profit to profit. General Ledger, let's look to the hand tools, this is the asset account. We started by buying cash tools in cash, $500, then in January 10th, we bought cash at $80, that's $580. In December 31st, we did the revaluation and we debited the income statement with $100 and credited hand tools with $100. Hand tools here, income statement is $100 and it's reduced from the hand tools, so the balance is $480. I hope that this one is clear, and when we do exercise, it will be more clear. Thank you very much.